Okay, Suresh, welcome to the Founder Thesis podcast. I wanted to speak to you because you have spent 13 years in the bond market. You are the founder of Bondbazaar, which is in a way disrupting the bond market. And I understand bond एक चीज होती है. People talk about bonds and it is an important part of the financial world. But क्या exactly bonds होते हैं? What is their importance? I am not really very clear on that. So I really want to understand from you everything about bonds. Can you take me through a little bit of like where did bonds start from? What is the history behind bonds? What does this term bond mean? For example, like these are some of the things I'm curious to learn.
First of all, thanks Akshay for inviting me for this interaction. Always good to interact something, and your start question is also interesting. From where the bond started, and the way you started that I spent 13 years in bond market, and then I tell you something about that one. I have more than 20 years of experience in financial market, and when I say 13 years in bond market, because that was a direct you know exposure or managing the bonds, but indirectly I was exposed to the bond market for last 25 years.
Okay.
So the word that when we talk about that, why I said this one, because when we say that how the bond started, right, and what is bond, it is interesting that everybody is exposed to bond market from their birth. So what is bonds? In simple terms, you know somebody is giving money to a person, uh, which is loan, and in return he will give interest to him for the specified period at agreed interest rate. Right? This is what it's the basically a normal lending function, nothing more than that. So that is what. And if it is a normal lending function, it means that is going on since how many years? Even I don't know. Maybe 1,000 year, 2,000 years, or something like this. So that is first thing. So it's a normal lending. So what happens in any lending functions? You start doing institutionalizing certain things, correct? And that's where the journey starts. So maybe bonds, when we say, it started when government realized that they can also borrow money from the public, from the institutions, and use this money for the development of the nation. So, in my view, the earliest nations who were more developed was like UK, USA, maybe 300, 400 years back. And they also set up something called their regulatory body. Like today, we have a Reserve Bank of India. They might have set up Fed and something like that. So they started managing cash flow for the government. They started borrowing money from the market, and government used to use this money for the development of projects. So that's how the bond market started. The advantage of bond market was like earlier when, as I told you, that you are giving money to somebody, in return you are getting interest and principal at a specified interval. Now these are more regulated and these are tradable instruments. So this is the biggest difference happens. Once the big product becomes regulated product, it has various advantages. You set the process how the bonds are issued. There is a regulatory body who ensures that the bonds are issued at predefined, you know, SOPs process. And if something goes wrong, then the investors are protected through the regulations. That's where
Am
the
I
regulation comes into picture.
am I correct in understanding then that B2B lending, जब एक business दूसरे business को lend करता है, like a bank lends to a Reliance, is called a bank loan, and B2C, when a business is borrowing from consumers, customers, regular people, that is a bond?
No,
No?
it is not like this.
Okay.
Even B2B can be bonds. So when you say B2B, like bank has given money to another corporate or even to government, if it is one to one, then agreement is between two parties, the lender and the borrower. Correct? So, and the borrower will pay interest and principal to the same lender. But the same thing is done through the bond market, then it's a tradable instrument. And then there are, once it is tradable, it means it is like equity market. What happens in the equity market? That the buyer and seller are not the original investors. It can be the secondary market. The secondary market develops. So that's the difference. In case of bond market, there is a secondary market of trading where somebody has given money. Let's say a bank has given money to a corporate through a bond market for 10 years, and he has to pay a regular interest at the rate of 10%. Right? That's what. Now, after 1.5 year, bank thinks that I need money, so he want to sell this bond. He can sell this bond in the market, but he is not required to sell this bond back to the issuer who has borrowed this money. He can sell in the secondary market, and somebody else, it can be an individual also, it can be a corporate also, it can be another bank also, will buy this bond. Now issuer will, on the record, that will check that now who is holding this bond, he will pay the interest to that guy on the interest payment date. And that is what bonds, it's a tradable instrument.
Okay, interesting.
Correct.
So, is this accessible to anybody and everybody, or do you need to be of a certain size? If I run a small business, मेरा let's say 10 crores का turnover है, can I issue a bond, or do I need to be a company with a couple of 100 crores turnover to issue a bond?
So the bonds, to issue a bond, you require a couple of things. Uh, like first thing is to be regulated. It is a regulated product, so you have to follow the guidelines issued by SEBI for issuance of any bonds. Right? So SEBI has put that guidelines that if you want to issue a bonds, you should have a credit rating from a rating agency, uh, which is appointed by SEBI. You should have a debenture trustee, right? And then there are certain minimum disclosure which you have to do through information memorandum, which is circulated before the issuance of the bond. With that, anybody can issue the bond. Size, there is, for the debt IPO, the size is 10 crore. The minimum issuance size is 10 crore. And other than debt IPO, you can issue the bonds. There is nothing specifically, but yes, the face value of the bond, the minimum face value of the bond is 1,000 rupees, means minimum investment start in 1,000 rupees in the corporate bonds. In the government bond, it is 100 rupees. This is interesting. So, so there are one part. The issuer, anybody can issue the bonds. From the investor perspective, anybody can invest in the bonds. Anybody. Retail also can invest, HNI can also invest, banks also can invest, mutual fund, insurance company, anybody can invest in the bonds. So bond market is accessible to everybody from the issuer perspective also, and from investor perspective also. But yes, they have to follow the SEBI guidelines.
Okay, interesting. So, minimum IPO size is 10 crores. So, IPO is like the first time that you issue bonds in a market as a company is called an IPO, or do you have to do an IPO every time you issue bonds?
Yeah, whenever, every time when you issue a bonds, right, you raise money from the public or you raise money from the institution, so that is called fresh issuance. You raise money, fresh money. So if you want to involve public, retail public, it is called debt IPO. Otherwise, it is called privately listed bonds. You can just raise money from institutions, and also it can be a listed bond. Both the processes are okay. But every time when you want to raise fresh money, you have to follow the same process again, which is good. Which is because every time you have to disclose all the information of fresh, ensure that you follow all the regulatory norms.
Hmm. Okay, okay, got it. So I think this makes it pretty clear that bond is not for SMEs. It's more for mid market and larger enterprise, because 10 crore is the minimum size, and then to get a credit rating would have a certain cost attached to it. You need a certain maturity level before you can access bonds as an instrument for raising money. Um, what is
Yeah,
the
of course.
uh, how much does the interest rate uh, stand for bonds as compared to bank loans? Again, I'm speaking from the point of view of the company. If as a CFO, I have to decide, do I raise bank loan, do I go for bond issuance? What is my way of evaluating which one is a cheaper option of funds for me?
See, there are multiple parts. Let me just talk about the size of the market and who raise money from the bond market, how you raise money from the bond market, right? Let's talk about. that right now most of the corporates, let's the government raises money from the bond market closer to 6.5%, closer to 6.5, 6 quarter, 6.5%. When it comes to high rated corporates, they are raising money somewhere between 7% to 7, 8.5, 9%, which is almost like Tata's, Birla's, and all. And then there are many other corporates who are raising money between 8.5% to 12%, 13%. So this is the cost which somebody has to pay if they are raising money from bond market. Now, people come to the bond market for various reasons. First thing is a diversification of liabilities, because if it is only one source of funding, which is banks, sometimes if you need more money, where you will go. You can't be dependent on only one source of funding, like whether it is large corporate like L&T, Tata, and second part is there are many restrictions for banks to lend money to many corporates. So, for various instruments. So, like if it is they are raising money against a particular land acquisition or something like this, and which may be safe, right? Or maybe so then they raise money from the bond market. They gives you that flexibility for the end. So they also come in the bond market. And the larger thing is bond market is much bigger. It's seriously huge. Right now, the annual issuance in the bond market, corporate bond market, is more than 10 lakh crore in a year. The outstanding corporate bond market is closer to 50 lakh crore. Correct. You get much wider investor base, much wider. You can attract insurance companies, PF, mutual fund, HNIs, corporate treasuries, everybody, right, including banks who are giving you any which way money through the term loan market or something like that. So
So
all sorts of
one
people raise
question.
money from the bond market.
You
Yeah,
said 50,000 crores is the outstanding corporate bond.
50 lakh crore.
50 lakh crore. Okay. Uh, what does
50
this
lakh crore is
compare?
outstanding.
Okay. What is the comparable number for term loan, like a bank term loan? What would be?
So let's talk about term loan market, which is closer to 100 lakh crore, 110 lakh crore, something
Okay.
like this.
Okay. Okay.
Correct. So
Hmm.
if you see the term loan market probably is growing at the rate of, so this is the outstanding term loan market, outstanding corporate bond market. So the outstanding term loan market may be growing at the rate of 2 to 3% on CAGR basis, but outstanding bond market is growing at the rate of 20% every year.
Okay.
So it is picking up because
Hmm.
it started off late. So if you see, let's say maybe 15 years back, corporate bond market was closer to 10-15 lakh crore and term loan market was closer to 90 to 90-95 lakh crore. Now it has become 50 lakh crore and the term loan market has become 110, 120 lakh crore. So
Hmm.
you can imagine that the bond market is picking up much faster. So till now, what was happening? Who were the
And
investors in the bond market?
in a developed country like US, what is the which is bigger?
Wow, in developed countries, definitely capital market is the biggest, and there is
Correct.
hardly any term loan market which exists in developed countries.
Okay. Okay. Everyone
So
wants
see,
the
capital.
liquidity option. So bond
Yes, of course, because it is much
basically,
more.
when you give a loan
Yeah.
as a bond, for the lender, you have liquidity as an option. Like you have a tradable instrument. So therefore, if you ever need cash, then you can sell that and get cash.
So see, vibrant bond market is the crux for any developed economy. So like the US become a much powerful during 1940s to 1970s, or maybe after the Second World War, when they developed the municipal bond market. Means all the municipalities start raising money from the bond market, and that money was used for the development of the nation, right?
Hmm.
So so the vibrant bond market is must if you want to become a developed country. So that is first. As you
Okay.
rightly said, it is regulated product. Second thing is it is a tradable instrument, right? And last thing is you attract wide range of investors, which is possible only through the bond market, which is not possible through the term market. So it is in the interest of the country that you develop the bond market. And once the retail participants start happening in any instrument, right, in the bond market, then you can mobilize money for each and every growth prospects of the country for the corporates also. Like what happened in the equity market today, retail has become a really big force in Indian equity market. So you are not dependent on DIIs and FIIs that they are also only going to support the market. Now retail is
What is
also,
DII? FI? FI is foreign
it is
institution.
domestic institutions.
Okay.
Domestic institutions in the sense mutual fund, insurance
Hmm,
companies, and those guys.
hmm,
FIs are the foreign institutions, right?
hmm,
So today you are not dependent on them, that if there is some problem in the market, because retail has become a significant force, like equal force as DIs and FIs.
hmm,
The same thing at some stage will happen in the bond market also. Because why it will happen? Just I today I give the size of see, bond market is more about efficiency. Efficiency at the issuer level, at the investor level also. So just few data, right? Like around 15 to 20 lakh crore is lying in the current account, where retail is earning 0%, right? These are all RBI data. Around 60 to 70 lakh crore is lying in saving account, where people are earning less than 3% to 4%. Around 100 lakh crore is lying in the fixed deposit account, where people are earning somewhere between 6 to 7%. Wow. It is almost like 200 crore, 200 lakh crore is the inefficiency. Out of that 100 lakh crore, which we typically call CASA, that is the entire profitability of the banks, because they are paying zero cost on this 100 lakh crore,
yeah.
and they may be earning even 8% to 10%. If they are earning, it means they are earning 8 to 10 lakh crore.
Hmm,
And who is losing in this entire process? Retail,
hmm,
HNIs.
hmm,
And they think that my 5 lakh rupees is lying in the saving account, doesn't matter, but actually they lose 50,000 rupees as a interest. And they think that if I keep in the fixed deposit, it's a fixed tenor, so I will not keep in the fixed deposit because I don't know when I need this money.
hmm,
But if they become efficient and they invest in the bond market, then they know that they are earning 10% to 12% on that money. So that is first thing, that is the inefficiency. Now when it comes to the bond market, you know if you can make anything between 8 to 12%, 13%, it's a huge money. You invest today, you can sell tomorrow. So for your holding period, you earn interest. So today, if you have a spare money, see, I always say that efficiency is everything. In equity market, you can wait for the timing, that you think that market is up right now. Once it will come down, then I will invest. Bond market is not about timing; it is all about efficiency. If you have money today, which is lying idle, invest, because every day lost is lost. You are not going to recover that, right? So it is about the efficiency. Bond market bring that efficiency, and just imagine that. I always say, it brings. See, sometimes in equity market you target 15% return, right? And the timing is important. But there is always a concept of weighted average return on your portfolio. So if your 10% or 20% money is lying in the fixed deposit, we are earning, let's say, 6% to 7%. And if you can increase the return by 5 to 7% by investing in bonds, just imagine what is going to happen your weighted average portfolio return, and probably your expected return on rest of the 70%, which is a risky portfolio, may come down. Second thing is, 5 to 10% money may be lying idle in saving account, current account. If you start earning 10 to 12% on that also, so suddenly on that balance 30%, you are making additional 5 to 7%. So this is where what we try to do, uh, try to bring retail in the entire game.
So,
Institutions are any which way
uh,
efficient.
so I'll come to this on the retail participation. I want to kind of first understand the supply chain of it. Like, how is a bond listed? As a company, if I decide, you said that companies want to have multiple sources of debt. So, if I decide I want to go in for a bond listing, then what's the process? Do I need an investment banker? Um, how does a bond IPO happen? Uh,
So I tell you how the bond is issued. Right? First thing, there are SEBI guidelines. SEBI is the regulator in India. Right? It is government owned. SEBI regulator. SEBI is regulating the bond market in India. SEBI is regulating the equity market in India. SEBI is regulating the mutual funds in India. The same manner, SEBI is regulating the bond market in India. Correct? So they have laid down the guidelines. If you want to issue any bonds, what things you have to do. So to issue any bonds, you require what? First thing is, you require a merchant banker who is going to verify all the information about the company and prepare the document, which is we call information memorandum of the issue, where all the information is contained. Then you have a debenture trustee. which is also SEBI regulated. Merchant banker is also SEBI regulated. Debenture trustee is also SEBI regulated. Debenture trustee is holding all the security because security will be created in favor of debenture trustee. He is a representative of all the investors in the bond. All the investor can ask all the question to debenture trustee that whether all the security is perfectly created, whether the company is submitting all the information on quarterly basis about their financial performance, everything they have to submit to the debenture trustee, and debenture trustee interact with the all the bondholders.
Can you
Uh,
keep comparing to equity market? So for an equity market, is there a equivalent of a debenture trustee?
in equity market, there is no security is created,
Okay.
so there is no need for a debenture trustee, right?
Okay.
But in bond market, so so the only difference between equity and bond is probably the debenture trustee because the security is created. Rest of the things like transfer agent, everything is same. The
Okay.
process is absolutely same.
Okay.
So now, once all these things are done, then there are two ways to raise money from the bond market for any corporate. One is the debt IPO, which is equivalent to equity IPO. The process is absolutely same. The way it happens in the equity market,
But
right? They will open the
equity is
IPO,
listed on like NSE, BSE. Where is the debt listed?
same
NSE, BSE.
NSE,
Okay.
BSE.
Okay. Okay. Hmm.
In the same manner, it is
Okay.
listed.
Okay.
So, second is, privately listed bonds. In case of privately listed bonds, in the primary market, retail is not participating. In the sense, they will raise money, let's say 1,000 crore, where institutions like mutual fund, insurance company, banks, everybody else can participate. And then it listed on the secondary market, BSE and NSE. Once it is listed in the secondary market, then retail also can participate. So the difference in public issuance, which is debt IPO, and privately placed bonds, which in the only is in primary. In the primary market, in debt IPO, retail can also participate. In privately placed, retail can't participate. But in secondary market, in both the cases, once it is listed, everybody can buy and sell. Even retail can buy and sell because everything is listed in the BSE and NSE.
Okay.
So this is the process of bond listing. They have to follow the SEBI guidelines, and which is very simple and straightforward. And their interest is protected through debenture trustee.
And you need a demat account to buy and sell bonds, just like you need a demat account for
Yes,
equity.
absolutely. The same manner the way it happens in the equity market because it's a tradable instrument, so it comes
Okay.
directly in your demat account. So okay, few more things. Then, as you rightly pointed out, what happens in the bond market. So securities will come directly in your demat account. Second thing is interest and principal, right? So in the information memorandum, it will clearly mention about brief details about the issuance, like the terms and condition on the basis of which the company is borrowing, the security which they are offering, the rating, everything will be mentioned. So they also mention on which date they are going to make the interest payment and which date they are going to make the principal repayment. Okay, so the interest and principal comes directly in the bank account of the investor. So issuer, let's say a company called you know Tata
Reliance.
Power,
Hmm.
or let's say Reliance,
Yeah.
raise money from the bond market, right? So the bonds will be transferred in their demat account once they get money from the investors. If they want to buy and sell, they can buy and sell from the secondary market. That is the second thing. But if they are holding the bonds on the interest payment date, Reliance Industry will make payment directly in their bank account. And when the principal is due, they will directly make payment in their bank account. So it is very, very easy. Let's say once the bond is subscribed in the primary market and the guy want to the bond tenor is 10 years, so Reliance Industry will continue to make interest payment. Let's say it is decided that they will make interest payment on quarterly basis, so they will continue to make the interest payment on quarterly basis. And
When
principal, that is,
yeah, I was asking about principal. Principal is normally paid only at end of the tenor, right? Or even it can be like every quarter, some principal is also paid back.
so Akshay, this is the beauty of bond market. It is decided upfront
Okay.
by the issuer, and the investor knows upfront that whether he is making let's say it's a 3-year bond, he may decide to make interest principal payment one third, one third, one third every year, and interest payment quarterly, half yearly, yearly, monthly, or on the maturity. All these things are predefined in the at the time of issuance and doesn't change during the life of the bonds.
Okay.
So investor is clearly aware that when he is going to get the interest, when he is going to get the principal. And issuer is also very clear when he has to make this payment. It doesn't matter to him that who is holding this bond on the interest payment date and on the principal payment date, because he will just check with the debenture trustee and registrar that whose name is appearing in the trust in the records. Whoever name is appearing, he will make the interest payment and principal payment to that guy. And those, and the best part about the bond market is all the details about all the investors completely, are recorded. So it goes directly in their bank account.
The data goes back to the issuer, to Reliance. Reliance will get the data that as on this date, who are my holders and their bank
Yes,
accounts.
whenever the interest and principal date will come, he will take the data from the debenture trustee and from the registrar and make the interest and principal payment.
Okay, okay, okay. Got it. Okay.
The way it
And
happens in the equity market, right? If
hmm,
you have to make the dividend payment, what do? You check that on the record date, whose name is appearing in the records, and you will make the payment to that guy. In the same manner it happens in the bond market. That's what the advantage of bond market is. It's a tradable instrument,
hmm,
complete transparency, not a single error happens in all these processes.
right. Okay.
Everything
So
is automated.
now, in the equity market, price is a factor of, like, demand, supply, sentiment of the company, their profitability. So many things determine what price an equity is sold or bought at. Um, in the bond market, there one determinant of price would be the face value. Like, this is a bond of, let's say, 1,000 rupee bond. So 1,000 rupee theoretically should be the price at which it is bought or sold. But what about other factors? Like, what are the other factors which influence price of a bond?
See, as you rightly said, demand and supply, but ultimately, the price of the bond is based on the rating of the bond, right?
Okay.
If the rating of the bond is let's say A plus, so normally all the A plus rated bonds today are available somewhere between 10% to 11% in that range. If some bond is more popular, then he may be available around 10%. If some bond is less popular, it may be around 11%. So normally, based on the rating, you can decide that at what price you want to invest in that particular company. Right? This is the beauty of bond market. At least there is some rating agency who analyze the financial position of the company, and this rating agency review the rating every year. And if there is
Okay.
any change in the credibility of the organization, they inform
Hmm.
all the investors. They publish the rating that yes, the company's performance is improving. They will improve the rating from A plus to, let's say, double A, triple A. And if the performance is deteriorating, they will inform that the performance of the company is deteriorating, so people can take a call based on the rating of the company. So this is first thing. Now when we say that credibility of the bonds and how the price movement is going to happen. So two parts. One part is from the issuer perspective, he has borrowed, let's say, 1,000 rupees, and he has to make an interest payment of 10% every year. At the end of third year, he has to retain the principal. For him, it doesn't matter. He will make interest payment of 100 rupees at the first year, another 100 rupees at the second year, another 100
Mhm.
rupees at the third year, and he will return 1,000 rupees at the end of third year. Right now, in between, what happens after one year, 1.5 year, let's say somebody has bought this bond at 1,000 rupees, want to sell. So the moment on the price can be, let's say, 10%, any which way is going to get the return. If somebody is saying that no, I need return of, let's say, 11% on that one, so then he will say that instead of buying this bond at 1,000 rupees, I will buy this bond from you at 975 rupees, so that I can, because the issuer is going to make the payment of only 100 rupees to me, but I can make slightly extra by this 25 rupees of capital gain, which I'm going to get from the issue, because issuer is going to make 1,000 rupees of principal repayment at the end of third year. So this is the only slight change can happen in the principal. Some bit of capital gain or capital loss can happen, but not much. That is what is bond market is all about.
And,
And
and this would
second,
depend on ratings, right? If the rating changes, then the expectation of return would change, and therefore the capital gain or capital loss will.
three four things can impact the price movement. One is the demand and supply.
Hmm.
The demand of the bond goes up significantly, people think that this bond is really good, right? So they may start asking more. Than the people instead of 1,000 rupees, somebody will say, I will ask 1,050 rupees or something.
But why would
Sec-
demand go up if there's no change of rating? An
because
example, like.
let's say I there are more than 10,000, 15,000 bonds are available in the market. Now, I like a particular company. I know that, let's say, this is a company called X, and I given money in the past. I like this company. They are good, and I understood this one. So, I think instead of investing 100 rupees, I may invest 500 rupees only in this company because I like this company. Simple. So instead of as compared to other companies, I like this company more, right? Rating is one thing, but ultimately, when you invest and you give money to anybody, if he return your money back, it's like a sovereign for you, right? He has not
Hmm.
defaulted, and so I 10% this bond is good, so I continue to invest. So this is
Okay.
how the demand keeps on going, and I so that's people hear from each other. He says that okay, XYZ is investing in the bonds, then I will also invest in the same bonds.
Okay.
Second thing is the price movement happens because of the interest rate change. RBI, like again the RBI policy is there every second month. So RBI increase the rate or reduce the rate. If RBI increase the rate, then people will think that why I should buy this bond at 10%. Let me demand, let's
What
say,
is the rate that RBI is increasing or decreasing? That overnight lending rate
repo
you
rate,
might say.
repo rate,
Repo rate. Okay.
which is the base rate at which RBI can lend and borrow money to the banking sector, which is fulcrum of the entire financial market in India and anywhere in the world, right? So they decide the base rate. Base rate basically, let's say today it is, let's say, closer to 6%. It means if banks are short of money, they can go to RBI and say that please lend money to me because RBI is printing money in India, right? Who is
Mm-hmm.
printing money in India? RBI.
Right. Right.
So
Right.
RBI has unlimited money. So they say, okay, if you are short of money, you can come to me. I will lend you money at 6%. And if you excess money, then you can park money with me, and I will pay you 6% interest. That's where it is called repo rate or base rate or whatever it
Hmm.
is.
And
So
this is
that is
supposed to be the
the
risk-free rate. This is
it is
like
absolutely risk-free rate. Means
okay.
you are giving money to whom? The person who
To
can print the
RBI.
money.
Yeah. Yeah.
So
Yeah. Okay. Got
so
it.
you can't default,
Hmm.
right?
Hmm. Hmm.
So that's the start point. Now let's say RBI increase the rate, decrease the rate by 1% because recently RBI has increased the rate by 0.5%. So it means the person who's borrowing at 10% will say now the fresh borrowing I'm doing do at 9.5% because RBI has reduced their benchmark rate. Right?
Hmm.
And if the RBI increase the rate, then by 0.5%, then he has to increase his borrowing rate also. So
Hmm.
that is another factor happens in the secondary market. The bonds which are already issued
Hmm.
will trade at discount and premium because the interest rate has changed,
Got
but
it.
the issuer will continue to pay the same 10% interest rate because for him nothing will change, right? Because it is already documented. And as I told you earlier, in bond market, once the bonds are issued, it will not change. So, but the secondary market, the price movement, some bit of movement can happen. That is the second effect. And the last, as you rightly said, which you were saying, yes, rating change. Rating deteriorate or improves. Then based on that also, people, if the rating is improving, then the same guy. See, these are the continuous borrower. I raised some money 3 years back. I locked in. I don't have a choice, but I have to continue to pay the same interest rate and something. Now today my rating has improved from A plus to double A. So if 3 years back I raised money at 10%, today probably I will raise money at 9%. So it means my bonds which are available in the secondary market will also start trading at 9%. It will trade at premium
Hmm.
and vice versa.
Got it. Okay. 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 Interesting. Um, so, is there an opportunity for a trader to make money by buying a bond when he expects the rating to go down? Like if you buy a bond when you're expecting a rating to go down, the price of the bond would increase, right?
See, actually,
No, it's the reverse actually. The price would decrease, right? Okay.
yeah.
Mm.
So you are saying trading opportunities for trader in the sense individuals or HNI, right?
Like in equity market people do day trading and like short term trading. So is there like that short term trading opportunity in the bond market that you
So there are two type of investors in the bond market. One is institutions,
hmm, like mutual
let's say
funds
mutual
and
fund
insurance
and big
companies?
treasuries. They are traders. They buy the bonds, from a perspective. Sometimes they have many factors. Sometimes it is for HTM in the sense hold till maturity, because they also mobilizing money from the retail and they have to make the interest payment for them. So they also buy because of the short term opportunities, because there can be a rating improvement, there can be a rate cut, because of that they can make some capital gain. Everything is possible. So there. But when it comes to the retail and HNI, normally or maybe in 99 to 100% cases, these are more like a HTM trade. They buy to earn interest during their whole period, not for capital gain.
Okay.
Because one thing is their quantums are small. Sometimes because the minimum investment can be 1,000 rupees, 10,000 rupees, even 10 lakh rupees, 1 crore, 5 crore, but still it is a very small quantum. To and see, bond market is slightly illiquid as compared to the equity market, but the options which are available in the bond market is humongous. Like, just to give you a perspective, that in equity market, in NSE there are 2,000, 2,100 companies are listed. In BSE around 5,000 companies are listed. In bond market there are more than 20,000 securities are available to invest.
Mm. So it
Various
doesn't mean there
instruments.
are 20,000 companies, because each company could have multiple securities. Like some securities may be
Absolutely,
issued in
absolutely.
2020, then 2021, and so okay.
Correct, correct. You are right. Like, if there is a power finance corporation who is raising money from the bond market, he may have more than 100 securities issued, which
Hmm.
has a different maturity, different coupon rate, different interest payment frequency. It can be monthly, quarterly, or something. All the things are possible.
Hmm.
So most of the people buy it more from a perspective to earn interest, and they sell when they require liquidity, but
Okay.
definitely not from a perspective of making capital gain. But
Hmm.
it is always good for you. Of course, in this process they can always make some capital gain. They make, yes, they make. It is not that
Hmm.
they don't make. It
Okay.
happens.
Okay. So, would the price of the bond also change based on the date? Because if interest payment is every 3 months and you bought it, and the interest payment is 1 month away, so you've technically the 2 months worth of interest should be factored into the price.
So how it happens, which is logical thing. That's This is the beauty of bond market. Is very, very logical and practical. So let's say interest accrue every day, right?
Oh, right.
If you
Yeah.
Right.
Hmm.
So if you buy and sell bond, let's the face value of the bond is 1,000 rupees, interest is 10%. Assume there is no change in the secondary market rate. Means in the secondary market also this bond is bought, it's sold at 10%. So now after 6 months, right? So there will be a 6 months interest will be added to these bonds automatically. Whenever the trading is happening in the second month, automatically it will be added. It is not that yeah, investor has to do anything. Uh, the system per se will calculate it automatically. So they will add 50 rupees of interest in this bond.
Okay.
So the bond will be bought and sold at 1,050 rupees. Why it will be like this one? Because at the end of 1 year, the issuer will make 100 rupees of interest payment to the holder of the bond.
Hmm.
But how much he should get ideally? Only 50 rupees, because he was holding the bonds only for 6 months, right?
Yes.
Because the
Yes.
interest rate was 10%.
Hmm.
But he is getting 100 rupees because 50 rupees for his whole position, and 50 rupees he has paid to the seller of the bonds when he has bought this bond in the secondary market.
Hmm.
So this is the transparency and the beauty of bond market. Uh, it is easy. It take care of everybody's interest, and this is the feature which ensures there is a tradability in the bond.
Okay. Okay. Uh, is the price decided through a bid auction kind of a mechanism? Like how does a sale and purchase happen? Like
How it happens in the equity market?
hmm, I'm not
The
familiar.
buyer and seller put their quote, right?
Right. And
So in the
then there's
same
a
manner
match.
it happens in the bond market.
Okay.
So
Okay.
yeah, it is absolutely the same process.
Hmm. When you say bond market is not as liquid as equity market, what does that mean? What are the implications of that?
See, couple of things, like one is like equity market. Let's take the example of Reliance Industry. Only one security is issued, which is Reliance Industries, and it is issued forever, right? It is one security. So if you want to buy and sell Reliance, it is only one security, one ISIN. But in this, so it is equity. But when Reliance Industry raise money through the bond market, they may raise money. There may be 100 securities which are available, right? Some securities may be maturing 3 years, somebody 3.5 years, something maturing in 10 years, somewhere the interest payment is monthly, somewhere it is quarterly, somewhere it is half yearly. So it becomes tricky. Now, as an investor, you bought one security which is maturing in 5 years and interest payment is quarterly. So that is because of this reason, because there are multiple securities. the liquidity is less. So somebody has to do the active market making in the securities. So, that's where the cash market of the exchange plays a significant role because it is an anonymous trade and guaranteed settlement. You can buy and sell. So let's say if you are holding a one particular security of Reliance Industries, even if the buyer is not there, you can put your sell order and somebody can put a buy order after that one. Looking at that, you want to sell it this particular price. So uh, the marketplace is very very important, which is just created now in India.
Hmm. Okay.
Marketplace,
Okay.
so where you can put, so it is a matter of time. I think in 10 years time liquidity will not be as good as equity market, but in 3 to 5 years time the liquidity will be really really good in the bond market. At least you will be able to buy and sell most of the securities the way you are buying and selling equities.
Okay. Okay. So you have Zerodha for Zerodha, Grow, Upstocks, all of these apps for equity market. What is the comparable for bond market?
So when you say Zerodha and Grow for equity market, so you are talking about a market which is 100 years old, right?
Hmm.
So, after 100 years, you created one Zerodha, one Grow, and couple of more companies like this one. Bond market is fairly new as we talk about for the retail investors. See, bond market is very old when it comes to the institutional market. You are not creating new market, but you are opening it for retail to buy and sell through a digital platform now. So comparable to Zero the Grow, nobody is there. Let me to be very frank with you. But SEBI came out with the guidelines 3 years back for online bond platform provider. So anybody who is selling bonds to the retail customer through a digital platform, means online, he should take that license. But before that, you should be a SEBI regulated broker, just like equity. It is the same process. Like you should be a member of BSE and NSE. SEBI will approve your applications. Once you are a BSE and NSE member, apart from taking membership of BSE and NSE, you should also take the membership as an online bond platform provider. This is one more additional requirement as compared to the equity market. So this process has just started. It is just a very very nascent industry right now. But uh, you know excitement is really good. What I can see, the volumes are just increasing almost 200 to 300% every year. So the growth is very significant, and for the obvious reason, because there is a clear advantage as compared to fixed deposits, debt mutual fund, and keeping money idle in saving account and current account, and the money is huge. So more and more people are aware that some product like this bond is available, where they can increase their return by 3 to 7%. It is safe, it is regulated, it is secured. More and more people are coming in the bond, and once they come in the bond market, trust me that they never go away. They know that the advantage is very high. It is an experience. So it is an experience which people are having right now, that you can just buy and sell just like equities. Interest and principal is coming directly on your bank account. These are regulated. SEBI is also there in the picture, right? So all those things are experience for them. So once they go through this experience for 3 to 6 months, they start more allocation to the bond investment. So that is first. So I think, coming back to your question, whether there is somebody as big as the current biggies of the equity market, no. But the potential is very high that in next 5 to 10 years you will see at least somebody making such big like zero Dhai.
And your company, Bondbazaar, is one of those.
Yes, we are one of those companies who are giving access to the retail public to buy and sell any corporate and government bond, just like equities, on a click of a button. Very transparent, very easy process. And it is anonymous trade, guaranteed settlement through BSE and NSE, just like equities. So this is a differentiator. Once they experience it, then it's a different ball game.
What is this anonymous trade? Why is that important?
It is important. Like when you buy equity, do you know who is the buyer and seller?
No. Okay, got it. Okay. Hmm. So you're saying that
Anonymous
before?
trade in the sense transparency. See, please understand, the biggest thing about anonymous trade, it brings transparency. You know that when the anonymous trade in the equity market started,
No.
do you know about Harshad Mehta case?
Yes, yes.
So they used to go in the ring, right?
And
And
can you
then
give details? I mean, I have heard of Harshad Mehta case, but I don't know the
no,
details.
Harshamana, in the sense, what I'm trying to say that that was an era when people used to go in the BSc ring, where
Okay.
somebody
They would be
they in the
shouting
ring they
and
used to say, yeah, yeah, yes, I want to buy this Reliance Industries. Something. This was that was not an anonymous trade. The buyer and seller.
okay,
There
okay.
used to be a jobber, and he used to say, okay, I want to buy this many shares and all other things.
Huh,
Then they
right.
used to report. So
Okay.
the bond market,
Hmm,
used to be the same manner. Now the like this cash segment gives you opportunity. Then the entire digitization started in the equity market somewhere
okay.
in 95 or something like that.
Hmm,
Now today it is much more transparent. The volumes have become, I don't know how many X, because I am sure even nobody, even the regulator is not calculating as
hmm,
compared to that era of 20 years, 25 years or 30 years back, right?
hmm.
The
Because
It is
it's
humongous.
digital and so
It
it
is
is
because
more
of
efficient.
digital anonymous trade and everything. The same thing is
Right.
happening in the bond market where it is anonymous digital trading.
And this
So
started
the
just 3 years
volumes,
ago for the bond market, you're saying.
yes, it was. It is like the cash segment was available, but nobody was offering that platform in a user friendly manner.
Hmm.
What we have done, we are using the same BSC NAC cash segment to give a user friendly platform to all the retail investors.
What
You
does
have to
this
make
cash
it.
segment mean?
See, cash segment is the same segment where equity, FNO, everything is available
Hmm.
of in BSC and NSE. So there also the bonds are also available to buy,
This is
but
like for
nobody knows
retail.
that it is so easily available.
Okay.
So we make it accessible to the retail investors, so they
Hmm.
can make really good use of the entire infrastructure. Easy
Okay.
buy,
Got it.
one click buy, one click sell,
Okay. Got
one
it.
click buy and one click sell.
So in the past, how bonds would be traded would be through a broker network. Like you would have some
Yes, so
broker, you would call your broker and say, I want to sell or I want to buy, and then he will talk to other brokers and find somebody who will be the counterparty. And that's how it would happen. Because it was
no,
largely
no, Akshay, it
digital.
was much worse, frankly.
Okay.
First thing is you don't know that which bonds are available to buy and sell. So you just say the broker that I want to invest something money. Can you suggest something? So
Okay.
he will say, okay, what is your target yield? He may say that because I need 10%, 11%, 12% or whatever. And then he will suggest bonds. You
Okay.
don't have any way to check that, these bonds are, available at the same rate or something like this one.
Hmm, hmm,
And unless until the volume is big, at least if you are not investing 5 lakh, 10 lakh rupees, the guy will say entire thing is a manual exercise. Why I should invest so much time for you? And at the end of the day, I don't know whether you are going to execute the trade or not, right?
hmm,
So once the trade is closed, then both the guys, what used to happen is actually the investor supposed to transfer money to the broker's bank account first.
hmm.
So suppose if broker may not honor the commitment of transferring securities in your demat account, then it's a big fraud,
Yeah.
right? All
Okay.
those issues were there.
Yeah.
So
Yeah.
these were the complete manual process. Now it is a completely a digital process through the exchange mechanism. Everything is SEBI regulated, so which is really good.
Hmm,
It is
hmm.
just like equities.
Okay, okay, okay. Very interesting. And so, as a retail user, if I want to go and buy a bond, then I can like go look at different bonds, look at their price history, all the details. And then, if I like a bond, then I can click on that bond, and then I put in a bid for that, or it will already show me this is the price at which it is available. Like, what is the retail user experience like?
So first thing is once you come on the platform, so these are the bonds available to buy and sell. Let's
Hmm,
say, see, there are more than 20,000 bonds are available. On any given day, there are 3 to 4,000 bonds where the buy and sell quote is there. Right? Not all the 20,000, 25,000 bonds. So what you
Where
can
does the
do, you
quote come
can
from? So it means that there is somebody else in the market who also wants to buy or sell
who
those
is
bonds.
ready to buy and sell, right? There may be a buy and sell quote both. So you may be
Okay.
knowing. Now, what SEBI has done, SEBI has already put the guidelines that if any bond is available to buy and sell, these are the minimum disclosure about the bond should be there. Like information memorandum, which was issued at the time of initial offer, that should be available for the retail or anybody to check information about the company. Rating rationale should be available. Then basic information about the issuer and this particular ISIN, like what is the rating, face value, maturity date, cash flow, ISIN wise cash flow, when you are going to get interest, principal, and everything. And SEBI has already put the guidelines. So all those information is available. So it is complete transparent. Before buying any bond, retail investors should check all the information about that particular bond. And if they are comfortable, then they also know that at what rate, what interest rate this bond is available to buy. Let's say the bond is available at 11%. If they think that this is not a right rate, I want 11.5%, so they can put their order. Of course, it will not be executed because the seller is at 11%. If seller may see that the buyer is at 11.5%, he can change his price just like it happens in the equity market, and the order will be executed. Or he can buy at the same price. Or if there is no buyer and seller, still he can put the order. And somebody may see that, okay, some buyer is there at 11.5%, he may put the sell order. So this is how the market typically works. So it's just like equities. So,
Okay.
but the advantage is all the information about bonds are available on a click of a button because SEBI has already put the guidelines.
Hmm. So, okay, now coming to retail participation, now you are recommending that if you have cash in your bank account, which is not earning any interest, then why don't you buy bonds? Because bonds are safe, you are getting better rate of interest, and they are liquid. You can sell whenever you want to. Um, wouldn't an even better argument be to buy a debt mutual fund, which is also investing in bonds, but then there is a professional who is deciding which bonds to invest in, and it is equally liquid, better rate of interest than putting your money idle in your bank account. So why should a retail investor directly participate in the bond market? Why not just buy a debt mutual fund which is run by a professional who's investing in the bond market?
So of course that choice is there. Of course, many people should invest in the debt mutual fund. I'm not saying, not denying, but there is a cost, right?
What is the
There is
cost
a cost.
typically?
So if you invest directly in debt mutual fund, you are getting 6 to 7% return, right? So the cost is like debt mutual fund. Debt mutual fund, you can withdraw money anytime, right?
Right.
So let's say Akshay want to invest money for 3 years, and you go to the debt mutual fund. Now, problem of debt mutual fund is they can not invest more than 1 or 2% in one particular security.
Hmm.
Second thing is they will invest in 1 month security also, 3 months also, 5 months also, 1 year, 2 years, 3 years, 4 years, because they don't know when the withdrawal can start because people can withdraw money anytime. So that cost is also allowed 1.5%. Let's say if it's 1 month money, it can be, let's say, 7%, 8%. If it's a 3 year money, it can be 9 to 10%. Right? There is a duration premium is also available for your investment.
Okay. Okay.
Then as a debt mutual fund, you will keep 10%, 15% cash also, because
Hmm.
withdrawal can, if today the withdrawal is coming and bond market is illiquid, so all this inefficiency cost you around 3 to 4% vis-a-vis direct bond investment. Now,
Okay.
let's say, as a Akshay, you say that, okay, I want to invest in 3 years. Definitely, it makes sense for you to go to. If you invest for more than 6 months, it makes sense for you to do a direct bond investment. But let's say if you are investing for 5 days, 7 days, 10 days, 15 days, you don't know when you are going to get need money. Debt mutual fund is always a better option because rather than keeping this money idle in saving and a current account, at least you are earning 6 to 7% during that whole period.
Hmm.
So it is all about that, choose the right instrument based on your investment goal. Investment goal is the most important thing.
Hmm.
Now, Akshay, I see you said about professionals and all that. Of course, very important. But tell me something that if you want to buy a state guaranteed bonds and you invest your time to study that bond for 6 months or 12 months, you have to just experience it rather than study, experience it for 6 to 12 months, and you put some time of half an hour. If you're earning 3 to 4% higher returns, doesn't it make sense for you? Because see, when we talk about mutual fund, equity requires entry and exit. Timing of entry and exit is more important. In bond, timing is not important at all. You have to invest when you have money to earn interest for each and single day when you have money. Bond is regulated. There is a rating agency. There is already a professional rating agency who is giving credit worthiness of the bonds. Once you understand that one, your understanding is also
Right.
clear. It is regulated.
Hmm.
So just getting experience, you are earning 3 to 4% higher. Why to lose that one?
Okay, so equity doesn't have a rating agency equivalent, but in bond market there is already a rating agency because of which you don't necessarily need to invest so much time in researching, because the rating agency
Yes.
is a shortcut for
So
research.
Akshay, I always suggest one thing whenever you want to take exposure in the equity market, please go to the equity mutual fund managed by professionals. They know which company to buy, when to buy. Because let's say the same, okay, I give you the same now. Fortunately, you started with the Reliance Industries name. I can use the same name.
Yeah, yeah, yeah.
Reliance Industries is a good company.
Hmm. Yes,
Yes, you
yes,
agree, right? It's a good
yes,
company.
completely. Yes.
So Reliance Industries share price was not going up from probably 2009-10 to 2017-18. I think 8 to 10
Okay.
years it was same.
Pre-geo.
You are saying it is a good company.
Yeah.
So let's say during this period, Reliance Industry also borrowed money, maybe 7%, 8%, 9%.
Hmm.
Have you got your interest? You
Yes.
every Reliance has paid regular interest, right?
Hmm.
But so you don't require any expert to tell you that the company is going to make interest payment regularly. You will just buy this bond and you are earning 7, 8, 9%.
Hmm.
But if you have bought Reliance Industries equity shares thinking it is a good company, of course it is a good company. Nobody can doubt. If you are in
But
India,
timing
it
isn't good.
means it is a.
If you buy it when it's
So
at
you
its peak.
require expert to say that today probably Reliance Industry is fairly priced, so it is not a good investment. It is not a bad company, but at
Hmm.
this price probably it's not a good investment. So frankly,
Right.
today also I don't know whether Reliance Industry I will buy the equity or not. I don't know whether it is a good price or bad price. But when it
Hmm.
comes to the bond market, if they I am going to make 7% or 8% interest rate, I will suggest, I will recommend. There is no risk. You will get your interest payment.
Hmm. Okay. Got it.
So
Hmm.
that's how I see where the professional intervention is required, where the professional intervention is not required.
Understood. Okay, fair point. Um, I'll tell you a couple of queries I have as a user, as a retail user. So my first query is this: the liquidity risk. What if I buy a bond which is illiquid? That when I want to sell it, I am not able to sell it. How real is that risk? And are there any strategies to avoid?
So let's go one by one. So are you buying bonds for trading purpose? Probably the answer is no. I will not
Yeah, yeah.
ask people to buy
Maybe,
bonds.
but
So it is more to earn the interest, right?
yes, yes. Instead of
So two
keeping money
parts is there.
idle in my bank account, like your perfect use case, like you have a couple of lakhs in your bank account idle as a safety money, you put it in bonds. So let's say that's the use case. So I
So
want
actually,
access whenever I need. Yeah.
so actually there are two parts. So let me say one by one those parts because probably I also started with this money is lying idle.
Hmm.
So that is one scenario when the money is lying idle, but then you are losing much more, almost like 10 to 12%. So that is
Yes.
one scenario where you have to choose that if you require money after 6 months, you can buy the 6 months bond. Let's say if you think that the liquidity can be a problem, but at least after 6 months the money will come directly in your bank account, something like that.
Okay.
That's how you can mitigate the risk.
Okay.
Second
So
thing
then
is
that's like an
actually we are
emergency.
harping more on the idle money, so let me correct it. It
Hmm.
is also about fixed deposits. It is
Hmm.
not only about money which is lying idle, it is also that you
Yes.
are investing in fixed deposits and debt mutual fund, vis-a-vis you are getting 3 to 4% higher returns. So
Hmm.
that money is also flowing. In case of fixed deposit, your tenor is fixed.
Hmm.
Right? So here also you can take a call on 2 years, 3 years bond. Then there is a added advantage that you can sell bonds, right? That feature is there. Also. See, I will today when the liquidity is there, you can sell, and the liquidity is also there. But to be very frank with you, nobody will tell you that yes, the bonds are buy and sell. You experience it. In certain securities, the liquidity is always there. There are out of
What are
25,000.
those? Like, give me some examples
It
where
is
liquidity.
like government securities. There is a liquidity. There is a liquid bond like Power Finance Corporation, REC, PSC. Those bonds have liquidity, so you can buy those bonds where the liquidity is slightly better.
And does your platform tell me which bonds are more liquid?
See, I I don't say which bonds is more liquid and those things because liquidity is not a criteria which is a subjective criteria,
But
right?
but you could,
My
right? You
plat
could look at trading volumes and show that.
Yes. So you have to experience it. So once you spend 6 months, 12 months, so you will experience it. You can always say, okay, these bonds are where liquidity is normally available. Here the liquidity is not available. Of course, my platform will show you where the liquidity because the buy and sell both codes are available. You will experience it. Like Zerodha tells you that which bonds are which equity are more liquid, which are not liquid. They will not tell you everything, right? But you know that if it is a Nifty 50 script or Sensex script, then definitely it is liquid. It is a Z group script or something like this one, it may be less liquid. So that is a judgmental call which you know always. The same thing is applicable to the bond market. So there are
Hmm.
certain bonds where normally the liquid is there, certain bonds the liquid is not there. You can take a call based on that one. Of course, where the liquid is less, it means the interest rate is slightly better. So it's a trade-off
Okay.
between risk and return.
Hmm. Hmm.
And last thing, see again, what you can do if you are investing 100 rupees in the bond market, you can divide that 100 rupees into, let's say, 20 scripts based on tenor. That something can be 5 months, 12 months, 2 years, 3 years, 4 years, 6 years. Second thing is based on interest rate coupon also. It can be monthly, quarterly, based on your requirement of funds. And the last thing, based on the rating also. You can be, certain bonds can be highly rated, which are AAA, available around 8.5%, 8%. Something bonds can be A rated, or something which are available 10 to 11%. So it is a mix of everything. So actually, by and large, you will be mitigated from most of this liquidity risk, interest rate risk, credit risk, because it's a fairly diversified portfolio which you have.
Okay. Uh, is does the money directly come to your account on maturity, or do you have to click something and withdraw the money from the
Nothing.
bank?
You are not required to do anything. Interest and principal will come directly in your bank account. It will come directly from the issuer.
Okay.
It will not touch any broker's account. It will come
Okay.
directly in your bank account.
Okay. Okay. Okay.
It's a
Uh,
SEBI regulation. It's a SEBI
okay.
regulated product.
Got it. Got it. So it is still not a very like a somebody who doesn't have much time. For him, it does need some amount of time investment, because you need to uh, build a portfolio of bonds. You're saying that uh, it is safest to have a portfolio of bonds at different maturity periods. So you need to build a portfolio, and then also have a portfolio which has from AAA rating to triple B rating, or like variety of ratings. Um, so it's not that like casual investor kind of a product.
Okay, so one is, let me just try to understand your question slightly better. In fact,
Hmm.
what you are saying, that you are earning 3 to 7% extra return, which was missing till now.
Hmm.
It is missing because you don't know about this. You don't have a understanding. You don't have a experience of a product. Is it okay situation? Would you like to
No.
learn something where you can earn 3 to 5%, 7% extra returns?
Hmm.
It is
Yes.
your
Yes.
capital.
Yes.
See,
Hmm.
growing capital, the impact of compounding is huge. Akshay. If you compound your wealth at 10 to 12%, just imagine within 5 years you are doubling your money,
Hmm.
which is huge, right?
Hmm.
So
Hmm.
that is first thing. So
Hmm.
would you like to miss that 3 to 7% because you don't want to learn? Now what you have to learn?
Hmm.
See, I am not asking you to learn all the companies which are available in the bond market. What you will choose? Something at company which is available at 9%,
Hmm.
something as 10%, something 11%, 12%,
Hmm.
and you might have, you know, invested small amount.
Hmm.
And then once you know that these companies are good, you
Hmm.
continue to invest in the same companies.
Hmm.
Let's say it is like Canara Bank. So you go on to the Canara Bank, you have invested in the Canara Bank fixed deposits. Once you know the Canara Bank is safe, it is safe, right? But it is an effort. But once you invested in the FD of Canara Bank, probably you'll continue to invest in the same FD forever in your life.
Hmm.
So it's a one-time learning. After that,
Hmm.
you continue to do the same thing. So
Okay.
why not to do the same thing in the bond market? So once you learn about one company, you invested, you given money to that company, and if your experience is good, you will continue to do the same investment journey,
Hmm.
and you keep on adding one company whenever the new things arise. It doesn't take much time,
Hmm.
right?
Okay.
And
Okay.
most of these companies, the big issuers, are listed companies in the equity market. So
Hmm.
sometimes there is a hype, like Shriram Transport. Bond is also available by equity. Reliance Industry, L&T Financial Services, Tata Power, many companies which are raising money to the bond market are also there in the equity market. Means you have a basic understanding about the company. There's a high
Hmm.
possibility you may have a basic understanding.
Okay.
So it's not difficult. Like banks are also raising money from the bond market. So
Hmm.
if you know State Bank of India, you know State Bank of India. What else you want to know? You
But
just want to
bank
know that what is that.
would have like say 7-8% rate of interest I mean, it'll
Huh,
be
banks typically
close
give you
to
around 8% of the 8% rate, but it is still better than bank
exactly.
FDs, which is available at 6.5%, right?
True, 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 true. Hmm. Okay, so tell me something. Uh, what happens in case of financial problems in a company? So, if a company is listed, is the has a credit rating of triple B, for example, that means that the credit rating agencies saw that there are some risks with this company. Now, triple B rating means that the bond will pay more rate of interest, and I would be tempted to just straight away go and buy only triple B rating. But what is the risk in that? What happens if there is financial stress in the company? Give me some use case, like some real world example to explain this.
So, of course, there is a credit risk, and credit risk is always there whenever you lend money to anybody. If you lend money to your friend, also there is a credit risk. He may or may not pay you back, right? The
Yeah.
same manner, if the credit risk is there with the banks also, like banks also defaulted in the past, right? Whether it is Yes Bank, whether it is many cooperative banks who have defaulted. So same manner, there is a risk, great risk in the bond market. So that's why you should be very clear about trade-off between risk and return, or I always say risk-adjusted return. If you are talking about triple B plus type of instrument vis-a-vis triple A, the interest rate differential can be as high as 5%. It means you should put more efforts to understand that company and track it more closely, because you are getting 5% higher return as compared to safest bond. So that is one thing should always be done. Now, what? Let's say companies have defaulted in the past. Of course, they have defaulted. Like if I have to talk about the real time case, it can be, let's say, DHFL, it is ILFS. They borrowed money from the bond market, they defaulted in the bond market, right? But like in DHFL, it was secured by assets of the company. So people have recovered to the extent of 40% of their principal amount because
Okay.
it was secured. But as I, even in my interaction with various people, I say that with each and every problem which happen in the bond market, once in a blue moon, there is always some default happens. uh, some default can happen, but regulator become much more vigilant after that one. They put more and more regulations around that one. Rating agency become much more vigilant because it's a developing market. It is not a complete fully developed market. So the regulations have improved a lot since last default which happened in 2018. 2018 ILFS and DHFL crisis default happened.
So, in the last 7 years, there's been no default in the bond market.
Very small things might have happened, but not any big things.
Okay.
The small things definitely, the people who are paying any interest rate which is more than 14%, 15%, 18%, let's be very clear that they are very risky. In those instruments, the default will keep on happening. But most of the investors are very, very informed investors. So they are aware that what type of risk they are taking.
Okay.
Correct?
Hmm.
See, I always say that target your yield based on your risk appetite. So if you are in the range of 9% to 11%, 12%, normally you are, most of these bonds are in a safe category bonds. So the risk is very low,
Okay.
and the probability that something going wrong in in near future is low. So whenever you are talking about a low rated bond, triple B minus and all that, be clear that it's a short tenor bond. So that in short tenor, probably the perspective much better that company may not default in next 6 months, 12 months, or 18 months type of period or something like that.
Hmm.
So, couple of things. One is bond market is regulated by SEBI. So, if some default happens, so the debenture trustee is there. What he will do, he will sell the assets of the company and recover the money and distribute this money to all the debenture holders. So that one thing is there.
Once
And
this default happens, can I sell it off? Do I have liquidity? Like, for example, you said 40% of the amount of the bond was recovered for DHFL, but I
hmm,
don't want to wait for that recovery process to happen. It would be more than a
yes, the
year.
trading happens. Yes, you are right.
Okay, so you can
Even if
trade
after
it.
the default,
There would
yes,
be
you can
someone
trade in
who
the
would
bond.
take a bet that, okay, this bond, I will give you 20% of the value today only, and then it's
Absolutely.
my headache to wait until whatever is recovered. So you can recover some value of it.
Yes, Akshay. In fact, in the
Okay.
DHFL also, a lot of trading happened post default also.
Hmm.
People got their exit. They sold
because
also.
somebody was expecting that some recovery would happen, and therefore there was a buyer for.
Absolutely.
Okay.
So even after the default, the trading in the bond never stopped. It
Hmm.
continued to trade because
Hmm.
it's a tradable instrument.
But it would be
So
at a
you can
massive
buy.
discount because it is tradable.
Yes, once the default happens, it can be at a massive discount.
Got it.
And that's
Okay.
why it is important that people should diversify their portfolio. Just give
Hmm.
you one example. If you are on a diversified portfolio, if you are earning 5% extra return, 5 to 7% extra return, it means what? That first year, if you have done a proper diversification, you earn 5% extra. Second year, another 5%. Third year, and means every year your cushion goes up by 5%, because after that, even if there is a 5% NPA, which is the rarest case, right? It is not that
Hmm.
in bond market default happens every second day. Otherwise, SEBI bond market is more regulated as compared to any other market, by the way.
Yeah.
It is
So
much more
the
regulated. So
investor expects to get the money back. It's a loan. So loan means
it's a
investor expects
loan.
to
It's a
get the money
loan.
back. It's not
So
equity. So yeah.
so the good part is, if you don't invest in the bond market, if you invest in the debt mutual fund, if you invest in the fixed deposits, I have a counter argument to that one, that any which way you are losing 5 to 7% every year. It is like an NPA for you, right? And you are not going to recover that money.
Okay.
Right?
Got it. Got it. Got
So
it. Got it.
the alternate option of not investing in bond, it means you lost that money. And
Uh,
if you compare with saving account and current account, it means you are losing 10% every year.
hmm.
In 3 years, you lost almost 40%, right?
Yeah. Yep. 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 Okay. Understood.
So that is also a worse situation for you.
Yeah. Okay. Okay. So let me end with this. Give me five bonds that you recommend as investments.
No, no.
As on
Frankly,
date, and
no, no.
yeah.
I can't give any recommendation on this podcast or in this interaction. It is
Okay.
regulatory wise not allowed. Once
Okay.
you become a customer, all the bonds are available on the platform. Even my newsletter and other things are daily published, where the bonds which are available to buy and sell or bought and sold yesterday, all the details, everything is available.
But how do I
Uh,
learn? I want to learn about which bond to invest in. How do I learn that? I don't want to buy
so
a bond and
Akshay,
then learn. I want to learn a little bit before I buy.
of course, you should learn before you buy. What you can do, they like for what we have also done. We have certain videos for people, what is bond, how the rating works, and all other things are there.
No, so that we
So
made this video. So okay, that much is done. But how do I learn about
that
whether I should buy a Reliance bond or I should buy L&T bond, or which, I mean, there are so many information sources for equity, like advice. This is a
so
good, like
Akshay,
research
we
reports.
once you become a customer, you of course ask more information, more things about a particular bond, and we support you in your investment. As a broker, I can help you in the investment journey once you become a customer. So,
Okay.
as since you are asking on this in your life thing, this is not allowed by the regulator. But once you become a customer, then of course we help you in your investment journey. You ask bonds which are available
But
at a
you are a
at your.
digital platform. How would you help? Like, is there a chatbot there through which I ask for advice, or what? Like,
So one RM is always allocated to one customer in the initial in their journey, so that they can always ask those questions to that RM, that these are my
is there
queries.
a minimum ticket size of investment that is needed to participate?
100 rupees for government bonds, 1000 rupees for corporate bonds.
So, how do you afford the salary of an RM with such small ticket sizes?
So trust me that nobody see, there are two parts in any market development. One part is development phase, and second part is matured phase. Once it is a matured phase, you are not going to waste time by asking RM which bond to buy. You know that how to select that 10%, 11% bond, you will do on your own. And in
Okay.
development phase, any which way, everybody has to invest in this all type of infrastructure, digital infrastructure also, and physical infrastructure also, right?
Mm.
So give you one perspective that nobody comes here to invest only 1000, 2000, 5000 rupees, right? They start their journey maybe small, maybe a lakh rupees, but then each and every penny start moving towards bond market, because it's a common sense that you are earning 5 to 7% higher returns. Why not? Second thing is, at some stage you also think that, why I'm taking the equity risk of 15%, I don't know whether I'm going to get 15% return or not. Why I can't settle for 12% return, which is
Mm.
better, right?
Mm. Okay.
So, see, Akshay, I have to help in your initial journey.
Mm.
You want to learn about bonds, you learn about a particular bond, in general bonds. and you want to experience this, I have to give you that experience, and after that everything is automatic. the
And how do
the
you
pain is
earn?
already sorted out to buy and sell, which is digital.
Hmm.
Learning sometimes can be a digital also, sometimes it requires human intervention also, so we are doing both.
How do you earn? If I'm investing 5 lakh through the platform, what is your earning in that?
See, I charge the issuer.
Okay.
Okay, let's say
Even
I
for a
am doing
secondary,
one.
because secondary means it is listed on the NSE. There is somebody
So there I
somewhere.
don't, so there I don't, earn anything. You are absolutely right, because this platform is free for the buy and sell. But primary income is good enough for me, because normally people, once I see, because secondary market is slightly liquid. Once you bought the bonds, you want to sell. So it's a combination of both primary and secondary. But primary market income is good enough for me to make money in this business.
Okay, so basically you make money through IPOs, like in a simple manner.
Whether it is debt IPO or privately placed bonds, that's where I charge the issuer, and that's where I make my money.
Okay, okay. For a privately placed bond, then you're like a merchant bank, and then you charge the merchant bank kind of a
Ha,
fees.
correct, absolutely.
Okay, okay. And what is the fees typically a merchant bank charges?
It varies from the issuers to issuers. Frankly, it
Uh,
is
I mean, like,
uh,
is it in basis points? Is it in single digit percentage? What is it?
it is always in single digit percentage. Definitely much lower than that one, but it is good enough for
Okay,
you to do
like
this. And see,
two
you are
to five
providing service
percent
to
or
both the guys.
something. Right, right, right. I mean, like there's, I mean, the intermediary needs to earn his take, right? I am not in any way saying that it is.
Intermediary need to earn their thing. And I tell you one more thing. Okay, let me just say that in the information memorandum, the fees is disclosed.
Hmm.
The arranger how much fees they have
For
made.
the
So
merchant banker. Okay.
SEBI has taken care of retail interest like anything. Don't worry about that one. So
Mhm.
fees, whatever they earn, it is mentioned in the information memorandum.
So
It is not an
the
undisclosed thing.
trading volume that you see on your platform, what percentage of that is IPO and what percentage is secondary?
See, it is almost like 25% is secondary and the rest is primary market. Once,
Okay,
where, we help them in their investment journey, and second is rest of the thing is secondary market.
that is okay. So that kind of sounds. I mean, in equity, the IPO would be like maybe 5% and 95% would be secondary, right? So it sounds a little
But
surprising to me.
that's where the difference is, because bonds mature every year. Let's say one guy has issued
Ah,
3-year bonds. After 3 years, this bond will mature. He will raise again money at the 3 years, right?
mm-hmm.
So that's why the primary will be much higher. Like as we were talking about Reliance industry, he raised equity through once, right? It is done. Now he's not going to raise money again from the equity market. But bond market, he is raising every month, every year, and continue to raise till the lifetime of the company. So
Okay,
bond market primarily, see, to see this market in this manner, it is a primary market mainly, because whenever the fresh borrowing is done, the
yeah.
bonds are available for everybody to invest. Secondary market gives you, you know
Secondary market is only for
easy exit
people
when
who
you
need
want.
liquidity. Okay.
Yeah.
Second, the point of bond market is not secondary. It's there if you need it, but the point is primary. That's what you're saying.
Yes.
Okay, interesting. And for an investor, is there an advantage of entering at the IPO phase versus entering through the secondary market phase?
Not really. Doesn't
There's no
matter.
advantage either ways. You
There is no
either.
advantage. it is
Okay.
it is more that not a pricing advantage, is more that when somebody is raising, let's say, 500 crore, you can decide that I want to invest 5 lakh rupees also, I can invest 5,000 rupees also, I can invest 5 crore also, 50 crore also, right? All the options are. But when you in the secondary market, in the same particular company, same maturity,
There's
if you want to invest 50
liquidity.
lakh rupees at that particular day, 50 lakh rupees of seller may not be there. So
Right.
that's why.
Liquidity constraints. Okay. Interesting. Very interesting. Uh, is there an opportunity for, like, in equity market, you have the robo-advisory model where there is an algorithmic trading that happens on equities. Is there an opportunity for that in the bond market?
3 years time, it is going to come. Definitely it is going to come. Right now you are talking about basic thing, basic understanding and all other things. There the digital, like the way we are talking and decoding the bond market is more important. Once you are one level above the basic understanding and advanced, then you say that, okay, now I understood everything. So through the robo advisory, just help me to select the bonds and all that. It is already started. We have attempted something in our recent app launch, which we have done just 10 days back, right? It is the first attempt based on your behavioral pattern, based on your likings. You can start looking at those bonds.
Okay. It will
It is
recommend
already
you bonds.
started.
Right, right, right.
Yeah, it started in that manner. It's a one step towards this journey, but this will become a much more prominent journey in near future.
Like Netflix. If you watch a Bollywood movie, it will show you more Bollywood movies. Something
Yes,
like
yes, of course.
that.
See, it's a world of AI now,
Yeah, yeah, yeah.
right?
True, true, true.
So everything will start moving towards that sooner than the later.
Yes, yes, yes. Okay, interesting. Okay, awesome. Thank you so much for your time, Suresh. It was a real pleasure.
Thanks a lot. Akshay. Thanks.